let's take a closer look at the markets. Joining us now, Lori Calvasina, RBC Capital Markets Head of U.S. Equities Strategy Research. Lori, thank you for being here. So you thought the summer rally did make sense, but you're more cautious heading into the fall. Why?
Look, I think we're sitting at levels, if you look especially at S&P 500 or NASDAQ 100, we're bumping up against prior valuation ceilings. We're also going into a tough period seasonally. September has been down, I think, 4 of the last 5 years, October 3 of the last 4. So this is a time when Wall Street tends to have some indigestion. And we're sitting on top of these valuations that are extreme. And frankly, I've been hearing all summer about the rate cuts that are coming. And guess what? The doors opened a little bit more. But frankly, I don't think it was that much of a surprise to anybody I've been talking to over the past 3 months.
Well, the market certainly reacted on it. Do you feel like Friday's move fully reflected the possibility of a rate cut, or do you think that there's still some optionality, at least in the equity markets?
So if you look at the S&P 500, we were up, I think, about 1.5%. But we actually, we had been down a number of days prior to that. So there had been a little bit of nervousness creeping in, which we basically then erased and kind of went right back to where we were around those mid-August highs. Where the real story was in stock market action on Friday was the small caps, which were up about 3.9%. I'm an old small cap strategist, so I was, getting an earful about this. And the thing we told people was that if you looked at positioning data, people were really net short this part of the market. It has been hedge funds' favorite rate cut bet since late 2023, and it's where they tend to go in, and when they really want to dial up their dovishness, they put a lot of money into this space. The problem is that it tends to be pretty fickle money, and it tends to really kind of fade. And if you want a sustainable trade in small cap, you need a hot economy. And that's not what we're seeing in the economic data right now, which is still sitting at like 1.6 and 1.7 for this year and next on consensus. So I think unless you kind of get a follow through on a hot economy, some of these trades are going to fizzle out. But people were excited on Friday and bid up a, kind of a very under-owned part of the market.
What's the best sector to own in a world where maybe in the short term, maybe for more prolonged couple of years, where inflation is sticky and yet we still get maybe it's one little rate cut in September, maybe it's more to come? What's the best sector to own then?
So I'll tell you, the one that we keep coming back to is financials, and it's not anything necessarily because of the history books. But when I talk to my banks analysts, and we've got two fantastic ones, John Arfstrom and Gerard Cassidy, and we talk about rate cuts, and they're always sort of coming back to the idea that if we get a few cuts and it keeps the economy healthy, that's a really good backdrop for the banks. So we like that. We like the reasonable valuation. And frankly, the banks really impressed me these last couple of reporting seasons, especially this last one, because they're managing tariff risk very well. Now, they don't have it directly, but they're keeping very close to their customers. I read a ton of earnings call transcripts because, frankly, that's what my clients are doing during reporting season. And the banks, I can't say names on TV, but there are a couple of them that have become really, really good sources of macro intel at this point.
Yeah, with the yield curve steepening, that should also be beneficial there. The big market story this week, of course, is NVIDIA reporting on Wednesday. It represents 8% of the S&P 500, a big sentiment tell. Against this backdrop of AI, where there's been a little bit of cold water, at least in the last week or so, poured over this thesis, worries about overextension there, overspending. How important is this? Do you think it's more important perhaps than even what we saw last Friday as an indicator heading into the fall for equities?
So look, I think there has been this sort of itch to rotate in the market all year. We saw a bunch of strategists calling for the broadening trade, the outperformance of value. What we've really had the last kind of year and a half has been a tug of war between growth and value. And if you look at growth relative to value, top 10 market cap names relative to rest of market, we've been hitting new highs. And to sort of see that rotation now come in and get a little bit of fuel from these rate cuts makes sense. It's interesting because normally in reporting season, we see the broadening trade work because investors, frankly, are forced to look at all these other companies and the earnings are pretty good. And so that kind of reignites animal spirits around kind of the more value cyclical parts of the market. The problem this time is you ran smack dab into tariffs. And so if you look at margin expectations for 2Q and 3Q, the tariff-sensitive sectors actually saw forecasts come down a bit. Tech was the only sector in the market that saw 2Q and 3Q margin forecasts go up since the start of reporting season. And so I think, that kind of itch, that kind of need to sort of rotate, it got delayed. And so I think that's a lot of what we're dealing with here.
Where do you find sentiment now of your clients?
It's mixed. I've talked to some folks, if I think back to conversations last week who were sort of looking at kind of some of the tech rec type names and thinking, things had gotten too far on the bearish side. I talked to other people who are very nervous. If you look at sort of the stats, and that's what I really like to focus on, because we can all be influenced by the person we happen to have talked to last. AAII is sinking like a stone in August. I think it came in at minus 14% last week, so 14% more bears than bulls. It is sinking without the market collapsing. And the last time we really saw that was actually 1Q of this year. It ended up telling you that there was nervousness seeping in, and the buyers weren't necessarily going to kind of come in if a major problem emerged, which is what I think we saw in April. Wow. If you look at CFTC, more of a gauge of kind of institutional hedge fund type positioning. That data actually went up to 1 standard deviation above the long-term average in a recent update. Now, 2 is where we tend to see major problems in the market, so it's not a screaming sell, but it's giving you a completely different signal. So we've kind of looked at the vibes overall as being mixed to end the summer.
Yeah, it feels like the levels that we're at are a little insecure at this juncture.
Even if you look at some of the consumer sentiment surveys, right? Like Michigan fell, but Conference Board rose, right? And so, we're seeing even on those which kind of generally head in the same direction. One of them told you, and frankly, Michigan is the better gauge for equity markets post-COVID, but that one, took a little bit of a breather. So I think that's happening in some camps, not in others.